Welcome to Managing the Future, the MIS podcast. This is your essential guide, really for college students and future business professionals who are diving into those critical concepts in management, business operations, and of course, information systems. Today, we're tackling something really fundamental, a financial concept that honestly underpins every smart decision, whether you're just managing your own money or, leading a huge corporation. We're talking about the time value of money. And this deep dive, it's specifically designed to help you, our listeners, from the Dr. Sam Pack College of Business and well beyond, to really get how money changes value over time, and crucially, how you can use these calculations for sound strategic decision making. We're drawing our insights today from the great foundation laid out in Richard Tedmon and Casey Wilhelm's Connect Master, Management Information Systems.
That's exactly right. The time value of money, TVM, as you'll hear it called. It's more than just some finance term you memorize. It's really a way of thinking, a mental model for making smart choices. It basically helps us answer that question. What is a dollar in your hand today actually worth compared to, say, a dollar you might get a year or maybe 5 years down the road? And believe me, the answer, it isn't always what you'd intuitively think.
Okay, right. Let's unpack this then. We're going to explore the core mechanics first. We'll look at concepts like future value, present value, interest rates, the basics. But then we want to go beyond just the basics. We'll dig into how things like effective interest rates and annuities actually impact your financial life. And importantly, for many business students, how big companies use powerful tools like net present value and internal rate of return to decide if, a multi-million-dollar project gets the green light or not.
Yeah, absolutely. And we'll try to connect these calculations to real-world scenarios you'll definitely face. Things like figuring out your best savings options, making smart loan decisions, all the way up to understanding those huge corporate investment strategies. Think about it. Maybe you're a startup founder considering a bold new product, or you're just graduating and weighing, investing aggressively versus maybe paying down student loans faster. This deep dive should give you the tools you need to think critically about those choices and really understand their long-term financial impact.
So let's begin at the absolute core. What is the time value of money? Why is it such a fundamental principle in finance and business?
Well, at its heart, TVM is this principle that a dollar you have right now, today, is worth more than a dollar you expect to receive sometime in the future.
Right.
And the reason, it's actually pretty simple. That dollar today has potential. It has earning capacity. You can invest it, earn interest on it, and end up with more than just that $1 later on.
So it's not just about inflation eating away at what you can buy. It's more about what that money could become if you had it sooner.
Exactly. That's a key part of it, is the opportunity cost of not having the money now. The fundamental relationship, and you'll see this formula everywhere, is that future value, FV, equals present value, PV times.
Yeah.
1 plus the interest rate, all raised to the power of the number of periods, N. So FV equals PV, 1 plus IN. That little N up there, the number of periods, that's where the real magic of compounding happens over time.
Okay, that immediately sounds like it applies everywhere. Personal finance, like saving for a car or a down payment, but also for complex business decisions, right?
Absolutely. Both sides of the coin. So the key calculations really bring this principle to life.
What are those key calculations then?
Well, the main variables we'll keep seeing are pretty consistent. You've got the interest rate, the number of periods, we often call that N per the payment amount, or PMT, the present value, PV, and the future value, FV. Just understanding what each of these means is sort of the key to unlocking how TVM works.
All right, let's tackle the first one. Net present value, NPV. For our listeners aiming for business careers, why is NPV such a big deal?
Oh, NPV is absolutely critical, especially for evaluating projects or investments. Basically, it's the difference between the present value of all the money you expect a project to bring in and the present value of all the money you expect it to cost over its entire life. Think of it like asking, okay, if we do this project, what's the net value, the bottom line gain or loss it adds to our company right now in today's dollars?
So you're taking all those future cash flows, positive and negative, and boiling them down to a single number today. And I guess positive is good, negative is bad.
Precisely. A positive NPV means the project is expected to generate more value than it costs, considering the time value of money. It should add value to the firm. A negative NPV suggests it'll likely destroy value. And this ties right back into that opportunity cost idea we mentioned. If you pick a negative NPV project, you're basically choosing something worse than other potential investments. And we'll touch on this later too, but it's closely related to the internal rate of return, or IRR. A key thing to remember is that for a project to add value, its IRR generally has to be higher than the company's cost of capital, often called the WACC, or weighted average cost of capital. Companies often set what they call hurdle rates, based on WACC plus maybe a risk factor, to judge these big investments.
Okay, that makes sense for NPV. Now, what about future value, or FV? How do we figure out what money today will grow into later?
Right. Future value is simpler in concept, perhaps.
Yep.
It just measures what a specific sum of money today will be worth at some point in the future, assuming it earns a certain interest rate or rate of return. It doesn't usually adjust for inflation itself, but it powerfully shows you the effect of compounding. Like, if you put $1,000 in an account today earning 5% interest, FV tells you what that $1,000 will grow to in, say, 5 or 10 years.
And I hear you don't need to be a math whiz to do this. Software can help.
Oh, absolutely. Tools like Microsoft Excel, Google Sheets, plenty of online financial calculators, they all have built-in functions for future value. You just plug in your starting amount, that's your PV, the interest rate, how long you're investing for, and boom, it calculates the future sum. Just remember, you need to be careful about compounding periods. Is interest calculated annually, quarterly, monthly, daily? That makes a surprisingly big difference to the final FV. Daily compounding grows faster.
Got it. Okay, so that's looking forward. What about looking back? That's present value, right? How does PV help us understand future money in today's terms?
Exactly. Present value, or PV, is sort of the mirror image of future value. It measures what a future chunk of money, or maybe a whole stream of future payments, is worth in today's dollars. It accounts for the interest you could have earned if you had the money now, or sometimes inflation. So if someone promises you, say, $10,000 5 years from now, PV tells you what that $10,000 promise is actually worth to you today.
So it helps you decide if a future payoff is actually a good deal compared to what you could do with money right now.
Precisely. It makes future money comparable to current money. It puts everything on a level playing field, time-wise. And again, spreadsheet functions are your friend here. They can show you the lump sum value today of a series of future payments, which helps investors figure out if waiting for that money makes sense compared to having cash now.
Okay, PV and FV seem like two sides of the same coin. Now let's talk about interest rate. We see interest rates everywhere, loans, savings. But what is an interest rate fundamentally? And why do banks charge it or pay it?
Right. Well, an interest rate is basically just a percentage. It's the amount a lender charges a borrower for using their money. Or, flipped around, it's the percentage a bank pays you for letting them use your deposited money. Lenders charge interest mainly for two reasons. One is the opportunity cost. They could be using that money for something else. The second is the risk that the borrower might not pay them back. So interest is essentially the price you pay to borrow money or the reward you get for saving or lending it. And financial tools can also work backward to calculate the interest rate if you know the other pieces, like the loan amount, payment, and term.
Makes sense. And related to loans and investments is duration. How do we calculate how long something will take?
That's where NPER comes in. It stands for number of periods. It's a function that tells you exactly how many payments or periods like months or years it will take for a loan to be fully paid off or for an investment to reach a specific goal. You need to know the interest rate, the payment amount, and the starting amount, PV. For example, it can tell you how many months it'll take to pay off your student loan if you make a certain payment each month. Excel's NPR function is really useful for this, especially for loans or investments where the payments and the interest rate stay the same over time.
Okay, NPER for duration. And the last piece of the puzzle you mentioned was payments, or PMT. What exactly is a payment in this TVM context?
Yeah, PMT, or payment. In this context, it usually refers to the regular, consistent amount of money transferred for a loan or an annuity. Think of your monthly car payment, your mortgage payment, student loan payments. Those are typical examples. It's that constant amount you either pay out or receive in each period. And like the others, Excel has a PMT function that's great for calculating what that fixed payment needs to be for a loan, given the loan amount, interest rate, and the number of periods.
This is where it gets super practical, doesn't it? Like you see those car ads, low monthly payment.
Exactly.
But they almost never tell you the total amount you'll end up paying over the life of the loan, right? With interest.
Right. They focus on the PMT because it sounds manageable. But if you understand PMT, NPER, and the rate, you can easily calculate the total cost. Sometimes it's eye-opening how much more you pay in interest over the years.
And that leads to big decisions, like with mortgages. You mentioned comparing a 15-year loan versus a 30-year loan.
Yeah, classic example. Let's say it's a $200,000 house. The monthly payment, PMT, on a 15-year mortgage will definitely be higher than on a 30-year one. But because you're paying it off faster, smaller NPR, and often get a slightly lower interest rate. The total interest paid over the life of the 15-year loan can be, tens, even hundreds of thousands of dollars less than the 30-year. So it forces you, the borrower, to ask that question. Can I handle the higher monthly payment now to save a huge amount in the long run? Or is the lower payment of the 30-year loan simply more feasible for my current budget, even knowing it costs more overall? TVM helps you see that trade-off clearly.
Okay, those are the core building blocks. Now, you mentioned going beyond the basics. Let's dive into some of those more advanced TVM concepts. These sound important for digging deeper, especially in corporate finance.
Definitely. These next concepts build right on top of what we've discussed, but they add layers of understanding that are really crucial for complex financial instruments and making more sophisticated business decisions.
First up, effective interest rate. We hear about the stated rate, or nominal rate. How is the effective rate different? Why should we care?
This is where compounding really shows its power. The effective interest rate, sometimes called the effective rate or AER, annual equivalent rate, is the interest rate you actually earn or pay on an investment or loan once you factor in the effect of compounding within a year. So a bank might advertise a savings account with a 5% nominal annual rate, but if they compound the interest monthly, you're actually earning interest on your interest each month. This means your effective annual rate will be slightly higher than 5%.
So it's the true annual return or cost after all the compounding periods within the year are accounted for. This must be why starting retirement savings early is so impactful, right? That compounding effect over decades.
Exactly. That's the key takeaway. Even a small difference between the nominal rate and the effective rate can become enormous over long periods. It's the snowball effect of earning returns on your returns. And yes, tools like Excel have an FDECT function. You just tell the nominal rate and how many times per year it compounds, and it calculates that true effective rate for you. Really handy.
Okay, effective rates capture the nuance of compounding. What about annuities? You mentioned them earlier. People often think retirement, but what are they and how do the calculations differ?
Right. An annuity, in finance terms, is basically a series of equal payments made at regular intervals over a set period of time. Think of it as a structured stream of cash flows. Now, the key difference we often look at is when those payments happen within each period. You have an ordinary annuity where the payments are made at the end of each period. This is actually the most common setup for things like mortgage payments, car loan payments, even many corporate project cash flows. You use the period, then you pay. Then you have an annuity due where the payments are made at the beginning of each period. Common examples are things like rent payments you pay on the first of the month for the upcoming month, or maybe some insurance premiums. The critical difference for calculations is that each payment in an annuity due gets to earn interest for one extra period compared to an ordinary annuity because it's paid earlier. So all else being equal, same rate, same payment amount, same number of periods an annuity due will always have a higher future value and a higher present value than an ordinary annuity. That extra period of compounding matters.
That makes sense. Timing is everything, literally. Okay, let's bring it back to the corporate world. You mentioned NPV earlier and its cousin IRR. How do big companies really use these tools to decide on major projects like a new factory, developing a new electric vehicle, or even something wild like SpaceX launching rockets?
Yeah, this is where TDM becomes a core tool for corporate strategy and capital budgeting. So as we said, NPV is the present value of all expected future cash inflows from a project, minus the present value of all the outflows, including the initial investment. Simple rule. Positive NPV. The project is expected to create value, so you generally accept it. Negative NPV. It's expected to destroy value, so you reject it. Now, the internal rate of return, or IRR, is a bit different. It's the discount rate, the interest rate at which the NPV of a project equals exactly zero. You can think of it as the project's inherent percentage rate of return. The decision rule here is typically, if the project's IRR is greater than the company's required rate of return, usually that WACC, the cost of capital, then accept the project. If the IRR is less than the WACC, reject it. Because investing in something that earns less than your cost of funding it, well, that just reduces the overall value of the company.
So both NPV and IRR help make the accept-reject decision. Is one better than the other? I feel like I've heard NPV is preferred sometimes.
That's a great point, and often true in practice, especially when comparing projects. NPV tells you the absolute dollar amount of value expected to be added, which is directly linked to increasing shareholder wealth. IRR gives you a percentage return, which is intuitive, but it can sometimes be misleading when you're comparing projects of vastly different sizes or projects with unusual cash flow patterns. NPV generally gives a clearer picture of the actual value creation.
So thinking about someone like Mary Barra at GM when deciding on, say, the Chevy Bolt EV or investing huge soys in autonomous driving, she's not just guessing, right? Her teams are modeling all the expected costs and revenues years into the future,
Absolutely.
discounting them back using an appropriate rate that reflect risk and the cost of capital, and looking for a positive NPV.
Exactly that. They're projecting R&D costs, manufacturing costs, marketing, sales revenues, potential maintenance, everything over the life of that platform or technology. Then they discount it all back to today. Same applies to Elon Musk with SpaceX or Hyperloop. These are hugely expensive, risky ventures. The upfront investment is massive. The justification relies on projecting enormous future cash flows, maybe far down the line, and demonstrating that even when discounted back heavily due to risk and time, the present value of those future rewards potentially outweighs the initial cost.
That does raise a really interesting question, though. How well do these standard TVM principles developed for maybe more predictable investments apply to truly cutting-edge stuff where the future is so uncertain, like orbital tourism for Virgin Galactic or AI development? Does the model still hold?
That's a fantastic question, and it gets to the heart of strategic finance. The principles of TVM still absolutely hold. A dollar today is still worth more than a dollar tomorrow, even if that tomorrow involves Mars colonies. What changes dramatically is the difficulty and uncertainty in estimating the inputs, especially the future cash flows, FE or PMT, and the appropriate discount rate. For highly innovative or risky ventures, the discount rate used in NPV calculations will be much, much higher to reflect that uncertainty. A higher discount rate means future cash flows are worth significantly less in today's terms. Companies might even accept projects with a negative NPV initially, viewing them as strategic investments or R&D that can unlock much larger but harder to quantify future opportunities. So it becomes less about precise calculation and maybe more about strategic justification using the TVM framework. But fundamentally, whether it's a safe hotel investment or a moonshot project, TVM provides the essential language and structure for evaluating its financial merits. And, you don't need to be a CEO to use these tools. You can start right now.
Go online, search for Excel loan calculator templates or mortgage comparison templates, play around with them. See how changing the interest rate or the loan term impacts your payments and total cost. It really brings these functions we've talked about, FE, PMT, and PER rate to life.
That's great advice. Well, that brings us toward the end of our deep dive today into the time value of money. We've covered a lot of ground, haven't we? From the absolute basics, what PV and FV mean, to the practical impact of interest rates, loan periods, and payments. And then into those more complex ideas like effective interest rates, the difference between ordinary annuities and annuities due, and how crucial NPV and IRR are for making those big corporate investment calls.
Yeah, and the key takeaway, I hope, for everyone listening is that understanding these concepts isn't just, academic bookkeeping. It's truly fundamental for making informed, strategic financial choices, both in your own personal life and definitely in your future business careers. Just keep that core idea in mind. That dollar today really does have more potential, more value than the same dollar promised sometime down the road.
So here's a thought for you, our listener, especially thinking about our students at the Dr. Sam Pat College of Business getting ready for their careers. Given everything we've talked about today, compounding, present value, opportunity cost, how might understanding these time value of money calculations maybe change your personal philosophy? How might it shift how you think about saving versus borrowing for those big purchases in your life? Your next car, maybe grad school, a house someday. How will this framework impact your next major financial decision? We genuinely love to hear your thoughts on this in the comments section. Let us know what clicked for you. And, of course, if you found this deep dive valuable, please do us a favor. Like it, subscribe to the channel, follow us, and maybe share it with friends or colleagues who might also find it useful. It really helps us keep this conversation going. Thanks so much for joining us on Managing the Future, the MIS podcast, and we'll see you next time.